Carnelian's quarterly catch up. We continue to host these quarterly calls for our investors and partners to share our views and insights about our portfolio and the current market environment. In this call, we are going to discuss what are we invested in and where are we looking now, pockets of bubble, and how to look at IPOs. Without further ado, over to you, Vikas.
Good evening, everyone. Happy Janmashtami to all of you. Good to meet all of you on this auspicious day where India is celebrating Janmashtami today. I'm sure some of you are also on holiday as it's bank holiday in many parts of the country. Friends, like every quarter, I look forward for this interaction with all of you where we can share with what has happened, last, 1 quarter or a little bit more, and also what are we thinking currently in terms of markets, giving update, and more importantly, what I enjoy the most is to do Q&A with you and answer some of your questions, which also helps in back us, some amount of learning in terms of what are you thinking, what are your worries, and what are your thoughts. So please, keep your questions, suggestions, observations, ready. Feel free to write them in the chat box if you want to, or you can ask in person once I end my initial opening sort of comments. So it's been interesting time. I'm sure happy times are back. Last time when we did markets was mood was a little subdued. People were more worried, but at least this quarter, I think there are a lot of happy faces around, and the markets have done really well. And so have we. So let me first, before let me start with our own how we have fared in this period, what we have done, especially in last 3 6 months. What it has meant for most of you are invested in one or the other fund. So what it has meant for you, let us revisit that. So as you know that we have a couple of funds. Our flagship fund, which we started with 4 years ago, is Carnelian Capital Compounder Fund. That fund has also done very well. That fund, if you see, since beginning of last 4 years, has delivered 19.7% return post our expenses versus benchmark of 13.1. In last 12 months, this fund has done very well. It has delivered 26% return versus benchmark of 8.1. And in last 6 months also, you can see, it's come out very well. So across all time frames, it has done very well. And so is the case. Similar fund, this is in the form of compounder strategy. And if you look at, last 12 months, again, this has outperformed by almost 10%. So this fund is a multi-cap fund, 50-60% large cap, 30% mid cap, 20% small cap. And we had some really good wins in that, which I'll talk about it, in the next few slides. Next strategy is what we call shift strategy. Again, one strategy which we feel, which we were very, very ahead of curve when we launched this in 2020, where we called out that manufacturing is next big decadal trend, and everybody should have massive investments, in this segment and sector. This strategy has done really well over last close to little less than 3 years, has delivered close to 46% CAGR return versus benchmark of 23%, which essentially means if you invested 100 rupees about little less than 3 years ago, this would have become 300 rupees by now, and post all the expenses. In last 12 months, 6 months, 3 months, on all time periods, it has done really well. Even Carnelian's, this same strategy we had launched in form of AIF last year in April 22. That time also market mood was not so great, especially around mid and small cap. I think most of the people were negative around the market. In fact, many people called out that manufacturing probably might not do well. But we were very confident. We continue to remain confident. And this fund also has delivered a CAGR of almost 29% post our expenses versus benchmark of 8%. And same thing in multiple periods, 12 months, 6 months, 3 months, 1 month. So I think this strategy also held us in a very, very good stead. YNG strategy, some of you are invested, which is a more conservative strategy. where we targeted 4 to 5% dividend yield and 10 to 12% earning growth. This strategy has delivered 29% CAGR versus benchmark of 10%. And again done very well in the recent past as well, last 12 months, 6 months, 3 months, all periods. Lastly, our bespoke strategy, which is a customized portfolio we do for clients. This is for high ticket, high value clients where we minimum start with 20 crores, and this is a very customized portfolio. This strategy has again delivered 32% CAGR versus 7% since beginning. In this, client portfolios tend to vary, hence client portfolio returns tends to vary. But this is a consolidated performance over last 12 months, 6 months, and so across all time frames. So this is our in short summary about our performance. But more importantly, what went into it, let me just quickly share with you. Uh, we've been very bullish on BFSI space, and we've been continuously increasing our space in BFSI, especially credit. Earlier, if you 3 years ago, we were more focused on non-credit because that time credit risk was very high, and we that slowly transitioned more towards the credit space, and which has again really helped us to gain the performance. We've been increasing our weight in IT, specifically in the mid cap IT. Pharma, API, and chemical is a space we have been increasing our exposure across, and which has again helped us really contribute our performance. Auto and we are already sort of overweight, but we reduced a bit of auto in this quarter because one of the stock had done really well, and we kind of wanted to buy into some other sectors. Uh, Engineering capital goods continue to do very well. So basically, our main approach has been to remain. These are more at a sectoral level, but I'll talk more about the stock level also. So identify good companies within those sectors, where we are very bullish on. So compounder strategy is done well. Shift strategy, IT. We increase our mid cap IT weight. Engineering capital goods, we have been very bullish on, and we continue to remain bullish on that. Auto angs again continue to remain very bullish. Little bit of tweak we have done in the weights, but that is more to do with when we sold some stakes in some companies. Not necessarily we are kind of changing our stance on the particular sector. Pharma API continues to remain very high conviction idea for us. Garmenting, very big opportunity. In shift strategy, we invest into companies which sits in between import substitution and export oriented, and within that we keep sort of investing, playing into different ideas. And but let me give you some of the ideas which have really done well and which we have kind of took aggressive stance across various against the market view. So I think one of the very big winner for has been Aditya Birla Capital. If you remember, we had done a call with the management also in our Wealth Creators series. This we bought at around between 90 to 100 rupees when the new CEO change happens. Part of our magic basket, which many of you are aware that whenever we look for companies in our magic basket with a view to capture both earnings growth and valuation re-rating. And when both comes together, we make a lot of money. So Aditya Birla Capital was trading at below one-time book, and when the change of CEO happened, we did a lot of work, and we were very convinced about that this will bring huge amount of transition and transformation, and it has paid off very well. Stock is up almost 70-80% in last less than 12 months time. We bought 6.5% position, which has become almost over 8% position in our fund. So this is how when something like this works, and still it has a long runway by the way. I mean, companies expected to grow at 25% CAGR over next 3-4 years. So idea is not to just buy that one pop. Idea is to buy a pop and then see compounding continuing. So that has been very good. Jammu and Kashmir Bank, again, you will find very few portfolios where anybody holds Jammu and Kashmir Bank. We bought it around 74, 75 levels. We believe that this bank is in a transformation. There are two things. One is the management change, and secondly, of course, Jammu and Kashmir is a very high growth trajectory post 370, and it is growing twice the rate of India GDP growth. So obviously, when a bank with a 65% market share in a particular region, which is growing twice the market growth of the rest of the country, I don't need to tell you what can happen to that bank. So we have a very high conviction, and we have taken good position in that as well. And that has, of course, served us so far. It's just beginning of a journey, according to us, in this situation. Indostar Finance, we bought part of a very big block deal when existing PE holder was forced to sell out because of the 75% requirement by the SEBI, and we saw that the Indostar was trading at 0.3 time. It was a very good opportunity. We did not have cash that point in time, but we still sold existing bank and bought into this. Stock is up almost 70-80% from that level we bought, but we think again it's a very good stage of journey. Today also after this as well, it is trading at only 0.65 kind of valuation, and it can, it's in transformation, it's in repair mode, and we think this is going to generate again superior return going forward. Tata Motors, it's again a company in transformation. We like the company a lot. Post in last 2-3 years, company has gained the market share across the board. It will emerge as the largest EV player in the country. Tata Motor earlier, lost their sheen, and even they were trying to sort of gain share in the passenger vehicle segment. But now Tata Motors has started sort of being recognized as a PV car. It became only a CV player, but now it has become a PV. We see a lot of Tata cars, especially in the EV space. So, and we bought interestingly DVR, which were trading at 50% discount to the main price, main stock. And as you would know that we were lucky, while we believed that the discount will narrow down, but we were lucky that company came out with a merger of Tata Motor stocks and Tata Motor DVR, which gave us additional 25-30% kicker on the stock price. So that also has contributed significantly to our alpha in last 12 months or so. Senco Gold, a very good company. Probably we are saying, it's a mini Titan in making, or a mini Titan in some sense. A very good company, very good. We participated in the IPO and we bought further on the listing. And still, I mean, stock is up about 25-30%, but we think it's a long way to go. So some of these names we have added to our portfolio. Some of names we exited was Eicher Motors, and I probably won't go too much into it, but because of the Harley Davidson competition getting launched, we thought at a very aggressive price point, we thought probably it will face challenge in terms of volume as well as the margins. So better to get out and keep looking at what happens in the market rather than remaining invested and then keep looking at the market. Because ultimately we are finding a lot of alternative opportunities. Nothing wrong with the company. Company is good, but marketplace is changing with the competition. So we thought it's better to get out. Airtel we sold. Hykel we sold. Hykel was the one stock where probably we feel that it has not served us well. We lost almost 40-45% of our value of our investors after we bought. First because of the accident of pollution board, and then I think management. There's a fight within the management, two section of the promoters in terms of increasing holding and all those things. We think these are not good situation to be in a company. So we exited that. ICICI Lombard we exited, and LIC Housing Finance we exited. LIC Housing Finance is again probably we call it a mistake. We remain invested into stock for almost 3.5-4 years and made no money. Made almost only 10-12% kind of return, which is a very big drag on the portfolio. But we call it in some sense our mistake, and we of course learn from the mistake. But these are some of the exits and entries in our portfolio and have contributed to our this thing. In shift strategy, we bought Scient. Again, in basically our thought process has been to buy mid-cap IT company which could transition into slightly bigger companies. Every IT cycle kind of creates this kind of opportunities. Scient is the one company where we feel that they are in a good transformative phase. They are into aviation, focus into aviation, and all of us know that aviation is a very big opportunity. Boeing, Airbus, all of them are getting orders and programs which are very huge. So in aviation, after almost 2 or 3 decades, we have started seeing investments happening, and this company is focused in that segment. And obviously, when these kind of trends happen, they don't remain last for 1 or 2 years. They last for 4, 5, 7, 10 years. So we think it's a company to be invested for a long period of time. So hence we bought it. And one spin-off of Scient DLM, which went public, we again invested into that at IPO listing and has done phenomenally well. Is up. So main Scient is up almost 70-80% this year from the time we bought. Scient DLM is up almost 50-60% from the time we bought, or actually more from the time we bought. So that we have done. Lotus is a very contra call we have taken, as against the market. Market, almost everybody is negative in Lotus, but we think that the pain is behind. Stock has corrected from 750 rupees to almost 300 rupees from the time we bought. But more importantly, capability of the company is very good. And whenever we find a good company in a bad cycle, and because of that prices have corrected, you want to take advantage of that bad cycle. And that's the precise reason why we bought Laurus Laboratories. We think that in 2-3 years time the stock can pretty much double, and hence we have taken a good sizable position. CI Automotive, again, company in transition, transformation, high growth, 20% plus kind of ROE and good growth. So we like this kind of combination. Whenever there's a good ROE and growth with low debt, we like that kind of setup. So we bought that. Tejas Network is one of the most promising company of the Tata Group. It is potentially Huawei or Nokia of India, and we think they just got a BSNL contract, which is I think very large in billions, and uh, and this company can potentially become anything, in like 8-10x also. It has that kind of potential. It's one of the most promising uh, telecom equipment company. And with Tata Group being there, and they have hired new CEO who has experience in this industry, working with an US MNC. So we think that this is again a potentially very, very good company. And some of the exits we have had, Tube investment, which we think a lot of it is played out. We made almost 4.5x money in that, and we think that now it is too finely priced. Even next 4 or 5 years of growth is right now factored in. So we thought it's better to kind of take money off and invest into companies where there are more better opportunities. Same thing in JK Paper, we exited after making our almost doubling our money in a very short period of time, in less than 6-8 months time. So we thought it's better to, and paper cycles are all, these things are always susceptible to cycles. So we invested only with the purpose of kind of capturing a win cycle, and which we are successful. Airtel and Hykel, we spoke that, it's like another fund we exited here also. And same thing in Mayur Uniquoters also we exited because we felt we had some other compelling idea which were better than this, in terms of, and here I think promoters are also aged. There's no succession planning. So we thought we made money and better to look at companies where these kind of risks are not around. Uh, so these are some of the things which we have done. While there are lots more, we have 20-25 stocks in each portfolio, but I thought it'll just give you some color how we've been thinking, and how we've been kind of planning our portfolio, in the space. Um, like I mentioned, some of these names already. I think I covered what has worked for us. Endostar up 80%, and Aditya Birla up 80%. Bank of Baroda we bought good position, which is up 70%. Gensa Tech we bought, which is up almost 128%. Newgen Software is up 118%. Scient is up 94%. Newland this year is up for us, almost doubled for us. Laurus Lab is 35%. Anup Engineering is up, almost 1.2x. Ratnamani, Larsen, Tugro. So all of them have done really well for us. Markets have done well, no doubt on that. But if you see our performance in last 12 months is significantly better. So some of our concentrated bets actually really paid off, and which we feel very happy about. So other thing which I always kind of just like, our portfolio level, we always try to see our portfolio quality should be faster, stronger, and cheaper. So our portfolio at a console level should be growing faster than the index, both on revenue and profits. Its ROE should be stronger than the index, which is basically 17.3% versus 14 point. We should have a margin of safety in the valuation, that it should be lower than the benchmark. Leverage should be minimal. So if you see our leverage, and this is minus BFSI, should be lower than benchmark, and our portfolio beta is lower than the benchmark. So this is how we sort of always look at our portfolio, and we like to showcase our these portfolio attributes again and again, because this really shows the kind of portfolio we are building. This kind of reflects the character of the portfolio which we are building. Same thing in case of shift strategy. Our revenue growth, profits growth is higher, our store ROE is higher. The margin portfolio is fairly valued here vis-a-vis index. Our leverage is almost negligible in this case, and again beta is very low. So again, our idea is similar here as well. Whatever portfolio we manage, the core philosophy, everything remains pretty much same. So this was a quick update on the portfolio side, across the board. But would be happy to take any question if you have later in the Q&A session. Now let me come to the market outlook here. What are we thinking? I mean, I know a lot of people are right now worried. Every alternative day, I get questions that are markets overheated? Are you worried about the market? Now, how should we think about it? And so, we thought we'll just kind of quickly cover that. I continue to believe India is in a transformative phase. We are in the middle of a very big structural bull run. It is going to last. India is going to see unprecedented amount of wealth creation journey as we move from $3 to $5 trillion GDP. We are very bullish in medium term as well as the long term. We do not find market expensive. I think there's a lot of talk about markets being expensive. We do not find. We think it's in a fair value zone. Neither it is cheap nor it is expensive. And I want to explain this. What do I mean by that? See, and I think last quarter, we had also touched upon what are the things which we go into valuation of an equity, right? So if you see, there are two very important factors for markets to do well: earnings growth and liquidity, right? Now let us first look at earnings, and then I'll come to liquidity. In case of earnings growth, you know, by and large, earnings have been holding well and expected to hold well. Let us go by. Banking is going at 18 to 20%. Auto is going, almost similar kind of pace. IT is going at 14, 15%. Telecom is going reasonably well. Capital goods and engineering is going well. Manufacturing is going well. Pharma is in fact come with a lot more higher growth. So that's expected to do well. Metals are holding on doing very well. Oil and gas is doing very well. So I don't know which segment of the market is not doing well. Of course, some consumer segments are holding on, not doing as well, or kind of slow growth is witnessing, but that's a very small part of the overall market. So, so, so I think overall, by and large, earning growth is expected to be in the range of 15 to 18%. Pessimist scenario will be 15, aggressive scenario will be 18. Now, if you are in that range earning growth, and let's say if you're trading at 20 P, it's fine. Why would you trade cheap? And I'll also come to this 20 P in a minute. So earning is holding on very well, and we think that the growth, the confidence around the sustainability of this growth over the next couple of years is very high. Okay, because none of these sectors are expected to sort of do badly, right? If it does badly, we can always take the call, but right now, at least, not expected. Second part which drives the market is liquidity. Now we all know that liquidity is very, very strong. The alternative source of investments are almost, I mean, if whether you look at fixed income or any other asset class, equity is, very promising. India as a country is still less than 5% invested of the household saving into equity. So there is long way to go further there. As far as the foreigners are concerned, India is still again very underrepresented in the global portfolios. If you look at India's GDP share in the world GDP and India's market cap share in world invested portfolio, we are still not even half, right? And that's expected to happen. So according to us, as interest rates, starts coming down, you will see a massive amount of flow coming through. And secondly, a lot of foreigners are waiting for elections to get over next year. And according to me, next year post-election, massive amount of flows will come. And and I don't see any negative flows happening, from that. So I don't see any reversal of the liquidity anytime soon. In fact, I see only accelerating. So if your earnings are holding and if liquidity is holding, why would markets correct? So I don't see any reason why markets would correct. So risk reward, of investing into many of these sector stocks are still in a favorable zone. And so I would say that. And other thing, people say markets are expensive. We do not think markets are expensive because equity valuations are driven by three things. ROE, which is the earnings growth, and discounting factor. Discounting factor in turn is combination of two facts. One is risk-free rate and risk premium. If you look at our ROE is higher than any emerging market globally. It is better than any time in the past in the history, right? So ROE part we are good. Earning growth is again, like I said, 15 to 18% kind of growth. No emerging market is offering that kind of growth. And more importantly, sustainability of this growth, future visibility of this growth is very high. And lastly, the discounting rate, which determines the valuation of the equities, is risk-free rate. We are lowest ever. If I were to see a difference between US 10-year and India 10-year, it's one of the lowest or the lowest ever. It means the cost of capital for India has been, is very, very low. And as the confidence about Indian economy has been coming down, getting better, risk premium is coming down. And that's a very important aspect. And just to give an idea, we all understand in the context of fixed income that how does the valuation change with the change in the interest rate or discounting factor. So let us say for a 10-year paper, 1% or 2% drop with a 10-year paper duration is 6. So 2% drop in the interest rates will lead to the appreciation of the security by 12%. It's a broader approximate kind of rule of thumb, which most of us know. But how does this work in case of equities? It is less understood in case of equities. A 2% drop in the interest rates, everything else remaining same, impacts the equity valuation by almost 37, 38%. So if let us say earlier 20 PE was there, just by 2% drop in the discounting rate, your equity valuation will end up going to 26, 27 times, right? So this is the kind of change it has impact it has on the equity valuation aspect. And hence I always say that if all other factors, whether it is growth or discounting rate, are changing, why Indian equity will trade at the same valuation as the historical level or compared to other emerging markets? There's no reason. And this is what, the essential part one must understand, whether it is expensive or not. So we don't find Indian markets expensive. It is in the fair value zone. We continue to believe manufacturing is a very big trend, technology, very big trend. It's a decadal theme. Just because stocks have done well does not mean that it is over. So if you are invested, continue to remain invested. Don't lose your, it's very, very wrong to sell stock just because they are doing well. They can continue to do very, very well. So it's a theme which is a decadal in nature. We will see companies becoming big in this. I have seen, companies becoming 100 to 200. Sun Pharma went from 1,000 crore market cap to 3.5 lakh crore market cap when the cycle turned. L&T from 10,000 crore market cap to 1.5 lakh crore market cap, and to now whatever it is. So every cycle, 2002 to 8 cycle, Thermex became 20x, 30x, Bharat Force became big. So all of companies, when the cycle changes, companies become very, very big from there where they start with. So hence, we think it's a very, very big thing, going forward over next 10 years. And also people think that very often we get the question that, are you getting ideas? I'm saying with a lot of responsibility, we are spoiled for choice. I haven't seen in my career of so many years so many opportunities. Banking is doing well, auto is doing well, manufacturing is doing well, IT is doing well, infrastructure is doing well. I mean, you can keep going on, and on the top of it, there are a lot of transformative opportunities coming about, right? So, very often you are actually spoiled for choice, and you have to keep narrowing down that where the returns are good, and that is how, or where the risk rewards are good. That is how you sort of narrow down your choice. So today I am telling you, at least I, we don't find shortage of ideas in India or in the markets right now. So that's very clear, at least from a risk reward point of view. We are still seeing lots of ideas. We don't see any systematic risk in the market as of now. Temporary tactical corrections can happen, just like some time ago when SVB crisis happened in US, markets went down from 18,500 to almost 17,400 levels. Those kind of corrections are par for course. They will happen. They can happen. Nobody can predict that. Whatever level of markets you are investing, you cannot predict that. So hence, those kind of corrections will happen, but we are not seeing any systemic risk. In fact, we are seeing a lot more stable economic and markets. Pockets of exuberance are definitely there in small and mid cap, because people are chasing stocks, money is chasing stocks. So one has to be very, very careful. One should not be just chasing those pockets of exuberance. We see defense and railway stocks are right now this kind of bubble getting done. It is similar to what we saw in new tech about a couple of years ago when everybody was chasing them out of FOMO, and we are seeing. I mean, and we figure out the FOMO based on the quality of the questions people ask us, from the inquiries people ask us. Very often, our investors say, "Why are you not buying any railway stock? Why are you not buying any defense stock?" And we, to be very frank, are very, very cautious and careful around that. We are okay not to make money when we don't understand risk reward of a particular thing. So this is how right now we are seeing markets in terms of sectors to focus on. Banking and financial. There are some structural plays and some contra plays which I want to share with you. Structural plays, banking and financial will continue to do well over next many years. And I'm telling you again, I have never seen banking in such a pink shape. Right, one of the biggest crisis of the banking has been NPA cycle around the corner. But if you look at a little bit of the history, we have had two NPA cycle or three NPA cycle. One was retail NPA cycle in 2007 period, 7-8 period. We did not have civil infrastructure at that point in time. Second corporate cycle we saw, in 2001 and 2009 to 14. That time we did not have IBC infrastructure in place. So today we have IBC and civil, and that's the reason. If you see, even middle of the pandemic, also we did not see retail NPA. We did not see corporates today are far more careful before leveraging. So we have, banking, we will not see the kind of NPA cycle we saw in the last time of 10% plus kind of NPA, because the frauds are kind of not possible to happen now, or maybe very low probability to happen now. Today, bank don't ask data from the customers for doing credit assessment. They take data from GST directly. They take data from income tax portal directly. So the ability or the potential or possibilities of fudging and defrauding have gone down with the digital stack India has built. So banks are far more capable, and all the banks cultures have changed in most of the PS, all PSU banks. Managements are far better than they ever been, and government intervention has gone down significantly. So we think banking and financial services will be a very big play. Uh, if I were to say, absolute amount of money which will be created will be by this sector, because it's one of the largest sector in the space. Automobiles, we continue to remain very bullish. Within auto and auto anks, we like both, but after 4 or 5 years, some amount of growth has started happening in the sector, and we think with the infrastructure getting built, more and more cars would be sold, more and more EV transition is happening. So we like between auto and auto anks both segment. Manufacturing, I have spoken, we like to invest into companies which fall in between import substitution and export orientation, and like I said, decadal opportunity. Some of the contra play we have taken, which were worth mentioning for you, is PSU banks. We think PSU banks are in part kind of a magic basket. They will get re-rated from here. PSU banks are in a very sweet spot. Uh, Most PSU banks managements are very solid, and we must give government this credit that they have not let any intervention in the bank. They have let with first they have found a good management or CEOs for each bank. They merged first, found good CEOs, and they are letting them do transformation. Most PSU banks have adopted very good technologies. If I were to say 5 years ago, they did not have technology platform. They adopted technology platform. So technology is no more differentiation, which earlier private sector banks had sort of whole domain. So PSU banks are reasonably well, because now technology is available off the shelf and banks have kind of geared up, right? So it's no more a differentiation. And management, and you can't beat their reach. Each of the bank have 10,000, 15,000 branch. You can't reach their reach. And all said and done, still there's no alternative to the physical reach of and credibility of these banks. So we think that most PSU banks will get further re-rated from here. Um, Chemicals is another sector where most people are bearish. I know many of the smart fund managers have sold recently their portfolio, especially in the specialty chemical. In 2021, a lot of people had, overweight position in chemical. People were chasing chemicals, and by that time, early 22 came. I think there was a kind of bubble situation in chemical. I remember we had reduced our most of the chemical holdings that point in time, because we kind of saw a lot of exuberance. And in over the next 1.5 years, most of the chemical stocks have become half from where they were, simply because in 21 most companies did not know, because of the supply chain disruption, how much to order, what was the demand. So every company ended up all ordering, and as a result of that, by the time 22 came, huge amount of inventory pileup happened at the end of the customers. And so you had huge amount of inventory pileup, supply chain got eased, and oil prices started coming down. So you had inventory correction and price correction. Both happened in this period of last 1.5 years. According to us, most of the pain is behind. And as a result, we think most chemical stocks are offering significant risk reward right now from here. And we have got very good sizable position in the companies we like at this point in time. And we think that we will make 25 to 30% IRR over next 2 3 years in this space. And we have chosen our companies very carefully after doing a lot of diligence. Same is the case with pharma, and APIs, of course, are more cuts across between chemical and pharma, but we remain quite bullish. Pharma also, we think as a sector will do well. US pharma is also beginning to price rise. The price correction has stopped, then I think environment is getting better there, so sector can do well. IT, we've spoken many times. We think mid cap IT will do very well, especially IT sector will do well, but mid cap IT especially will do well. So we keep on looking for our magic ideas there, where especially there are CEO change happening, transformation is being led, or companies have specific moat, which they can deliver, like of Science I talked about. So that's there. And lastly, within the conventional energy space, we think that right now it is the common thing to buy new renewable energy, but world is staring, India is staring at a shortage of energy. As India is growing, I don't think we have enough supply of energy. So you will see demand of thermal power, conventional power will in next 6 to 12 months time you will see kind of shortage happening, and as a result of that, power prices will go up, and coal prices will go up according to us. And so it's an interesting sector to look at. Of course, you can't look at this from 5 year perspective, but it's a tactical play one can kind of really look at. So these are some of the thoughts on the sectors. Last, I think this is one thing I wanted to kind of really put, because I feel that there's a huge amount of frenzy which is going on right now in the IPO market. 10,000 crores subscription in a company based in an SME company. This is kind of really telling you that crazy amount of frenzy is there. Kind of promoter selling, private equity selling happening in last 3 to 4 months is again telling you that some amount of worry point has to be there. So IPO market is again heating up. Companies are getting subscribed, 30 times, 100 times, 200 times. Whenever these kind of things happen, it only shows that market is right now going through a FOMO phase. And hence, I would suggest all of you to be very, very careful, super careful around the IPO. That's all I can tell you. uh, this is again my favorite chart when I try to kind of say that markets are cycle. Even in a structural bull run, you will see multiple cycle playing out. So I'm not saying market oscillates between fear and greed, and that's what makes it cycle. Now, very we think. I mean, of course, 2020 was a huge amount of pessimism and all, and we started kind of last 2 3 years have done well. We are somewhere, I think, in my opinion, somewhere in between enthusiasm and greed phase, somewhere here, and I think still euphoria is slightly away, in my opinion, at least 2 years away. But in this is the time where a lot of risk starts getting taken. So one has to be very careful, because you should assume that if you buy here, you will never be able to get out here. You will be able to get out only somewhere later. So one has to assume that a lot of margin of safety should be there. Cycles will be there. Every market has cycles. So will this. One should not fool himself that we are in a structural bull market, so there won't be any cycle. There will be cycle. There will be risk always around the corner, and so we have to be cognizant of that. So we feel that we are somewhere here, and one has to be. You can't ignore this run also. At the same time, you have to be very careful while playing this. Our advice to investors: lot of wealth to be created in the next decade, no doubt about it. I have a zero doubt on that. That we India will create massive amount of wealth, much more than what we have created in last 70 years. I can tell you our market cap, in my opinion, will double from here in next 5 years time, 7 years time. Anybody's guess, but in this period, in this decade for sure. Now, only thing I would say from investors' perspective, you decide आपको जल्दी चाहिए या ज्यादा चाहिए, because jaldi is what creates risk. If you are in a hurry, you will bend investing principles. You will fall into trap of tips and all those things. You will fall into trap of making money faster. FOMO will attract you, because hurry. When you are in a hurry, you see always somebody else's train moving faster. Your neighbor's line is moving faster. So you always kind of want to do in somebody else's boat, and that's what leads to the most amount of accident and investing errors. As we know that to recover a 50% loss, you have to gain 100% in some other skip to recover that, right? So it's very hard. And whenever you encounter this situation, even if you have one stock in your portfolio like this, you will have, it will bring down over your overall IRR down, which is again an enemy of jada. So jaldi ki jada, that is what you have to sort of choose. Both are definitely not not does not go together. Very exceptional investors can make both jaldi and jada, but we are not one of them. If somebody thinks somebody can make great, good luck to them. So I would say focus on investing principle, gaining knowledge, and following process. That's at least what we are doing. Avoid FOMO at any cost. That's where the most people lose their hard-earned money and capital. Lastly, portfolio quality degrades in bull market. Always you start degrading one by one. Some reason comes which is very convincing, very logical. I can tell you, I have seen many cycles in my career in the market, and every bull market, when bull market down goes away, you think back and say, oh, why did I buy this stock? My God. So those kind of things do happen. So guard against that. What we are doing, we are again, like I said, focusing on our investing principle, gaining knowledge and following processes. We are watching this very, very carefully. We are watching new trends very, very carefully because that is where the most opportunities do lie. Just like we did watch spotted manufacturing early in 2020 ahead of time. Our biggest focus is to keep on looking for new and emerging trend. Like I just said today, conventional energy is emerging as an interesting trend. So you have to, in investing, you have to keep your eyes open and keep looking for newer and interesting trends. Manage your emotions. So I think that's a very thing in market, according to me. Maintaining balance is the most important aspect. Money, of course, you have to make, but enjoying the journey and enjoying the making money process itself is very important. So at least we are trying to do that part. While we make money, it's important that we keep our, balance. We don't lose our balance and we keep our head low and keep doing well. So that is what we are doing. Thank you very much for patient listening. I will be very happy to take questions.
Thank you, Vikas. So I would request the participants to use the raise hand function. Yeah, so we have a question from Ratan. Ratan, you can go ahead. Hello, Ratan, I've unmuted. You can go ahead.
Hi, first of all, thank you so much, Vikas. It was very, very informative. I have not attended. I mean, like I have attended this as a first time. So a lot of more meaningful insight. Thank you so much. Just one thing, I mean, the big question. I mean, will you share this PPT which we have shown?
This probably we may not show because generally we don't like to talk about stocks. No, only for our investors we talk. So this is an investor call, so hence probably we may not share. But if you have any question, happy to, you can connect with us offline and get anything.
Perfect. Yeah. Thank you so much.
We have a next question from Ashish. Ashish, go ahead.
या हाय विकास सतीश आशीष है। पहली बात तो बहुत बहुत पैसा बना है इन्वेस्टर का, काफी खुश हैं लोग, सभी लोग। Am I audible?
Yes.
Yeah. So thank you for that. And my there is a one technical part of it. I just wanted to understand what was the selection and allocation effect in our portfolio. If you can bring a light up on the same overall, like shift strategy, shift one.
What was the
Selection and allocation effect overall.
Selection and allocation, what?
Effects on the portfolio.
I mean, I would not have sort of specific data. I'm assuming your question is that how much money did you make because of the stock selection and the sector allocation, right?
Right, correct.
So, if you ask me, the way we would also like to believe is that because manufacturing shift strategy is anyway focused on the manufacturing, it was a very niche sort of focused strategy. Large part of, because ultimately manufacturing and technology, we are making money, we're investing. Large part of the return should be determined by the stock selection because, like I said, even within IT also, if we outperform by 60-70%, it is more to do with the stock selection. So, but I don't have the data right now of late, but I'm happy to share with you, and then I would take the note and he will definitely share with you data. But I would believe that will be large part will be stock selection.
And also to continue upon the same, I would also love to have appraisal data, understand the performance measurement, understand the performance attribution. But if something we can get it around the luck factor in the portfolio, I just wanted to understand the appraisal one. The performance appraisal.
Sure. I mean, I wouldn't have, but we will be happy to share it.
Yeah. Thank you once again. It was nice. You guys are doing fairly well. And it's lovely. Thank you.
Thank you, Ashish. We have the next question from Yogin. Yogin can go ahead.
Yeah. Good evening. So I have written my question regarding this media news coming about corporate governance in Adani Group and exposure of PSU Bank to Adani Group. So whether you have any views how PSU Bank's exposure may be affected because of these rumors and.
So I think, frankly speaking, this PSU Bank's exposure to media, Adani Group exposure to, first of all, is not very large. Secondly, a lot of exposure which they have is backed by the cash flow generating exposure. So it is asset backed. So we don't see, we have looked at it. A, it is not large as a part of the overall proportion of the banking system. B, it is again backed by the cash flow generating assets. So we do not see any major cause of concern on that at this point in time.
Okay, thank you.
Aman, can let me just take some questions from the chat. I can see a lot of questions. So, how are you able to maintain the beta of the portfolio of Shift at 0.5, given that underlying stocks are predominantly mid and small cap by nature, and by small and mid caps are considered high beta? I think Giriraj, the good question. So again, the way we think is that at least we try to build a portfolio stock based on the fundamental business model, which is stable and not very volatile. So if you see most of our company which we have bought, are very, very solid business models run by great management teams. And also we ended up buying at the time of transition. So, probably slightly ahead of the trend. So, if you have lots of interest in the stock, every fall, investors, the newer set of investors ready to buy. So as a result of that, stock does not fall, right? So typically, and we don't really target a beta, by the way. It is just an outcome. We follow our process, and we follow our process, and as a result of that, this beta is an outcome. Frankly speaking, it's not that we target that beta should be 0.5 or 0.7 or 0.8. Our process allows us to get investments which are less volatile, and that's all I can offer as an explanation. And probably slightly early, if you buy, more and more people are ready to buy when the stock corrects. Structure shift as 65% small cap and rating. Why have you kept benchmark 500? So I don't know if you're Sumit, if you're aware, but SEBI is mandated to choose only two benchmarks now. There is no mid and small cap benchmark. SEBI is mandated to do BSE 500 as a benchmark across all PMS. So we have to follow that. But even just to give an idea, even if we compare to mid and small cap, we are outperforming by a big margin. So if let's say in case of shift strategy, our return is 47 versus benchmark of 23. If I were to compare that against the 47, the mid cap or small cap benchmark would be maybe 30, 35. So we still have 13, 14% annualized outperformance vis-a-vis mid and small cap also. We monitor that very closely, but we cannot give any other benchmark other than mandated by SEBI. Which are the chemical companies you are bullish on? So we have looked at some of the companies. We are largely liking the specialty, chemical company. We like SRF, we like Aarti, we like Laurus, as I spoke about some of them, and some of them we are still working on it. So we will, we have built positions in some of them. Some we will finalize as and when, we kind of decide. Which three PSU banks we are most bullish about? I think entire pack will do well, but what we like more is Bank of Baroda, PNB, Jammu and Kashmir Bank. But I can tell you most PSU banks will do well because the story is pretty much similar. But we like to buy companies where the MD, where we have a lot of confidence in. So some of them are leading to transformation journey. So we kind of like some of their name. Laurus, I have given my view on that. Pyramid Techno, again, it's a company which we like. It has gone public recently. The customer is chemicals, and as India goes more and more exporting to there are only two large companies in this space, Time and Pyramid, and we think they are very well placed to supply into that. IBC is a new growth area where these guys have fairly large market share. So we think this company will be doing very well. But of course, it's a long-term view, nothing to do with short-term. Stock might correct also tomorrow, and we don't care. We'll be happy to buy more if it corrects. How do you ensure portfolio is not influenced by change in political scenario, considering the central elections are approaching the next year? Well, we cannot ensure that political scenario can change. The only thing is I can tell you in the last 20 years, many governments have changed. Markets have still delivered 20% CAGR. So we are not making the point the government is not relevant. Government is important, but first of all, we don't see a major change in the political scenario in 24. Even if it happens, I think, which is a small probability, but even if it happens, we think that manufacturing can't be reversed. China plus can't be reversed. India's cost competitiveness vis-a-vis China can't be reversed. Our labor cost is $200. China's labor cost is $800. How can that be reversed? So some of the things are not reversible. Some of the trends are very long. So government support is only one aspect of it. some of it is also natural aspect of it. So why is the compounder portfolio doing only 12% per annum for last 2 years? It's quite possible depending on, see, or like I think if you are taking 2 years, probably in 2021 markets were very, very high. If somebody came in at that point in time, from there, markets are also probably delivering 8-9% return. So if we have delivered 12% return, I think we have done a good job. But you will always see cycles in the market. While the scheme performance will be a particular way, but individual investor performance might be impacted by the time of his entry and exit. So that could be a reason for that. I would assume that. How we look at small cap and SME IPO? We don't look at, to be very frank, small cap and SME IPOs. Or when we look at, we are very, very careful. There has to be very, very, very strong reason when we think that it can be 10-year opportunity or it's a very big structural opportunity, and we want to get into that kind of company. Then we might look at. Otherwise, like I said, there's a huge amount of froth and euphoria right now there. LC Capital, there's a question, Vikas, China is going the Japan way or this is temporary? And the fund flow will revert to China sometime soon. All this will change the manufacturing play in India, maybe more from earning expansion side. What will be the willing to pay for? So I don't think, first of all, China is going Japan way. China and Japan are very, very two different structures. China has its own challenges right now in terms of lot of, whatever is sentiment going around against China right now. I don't think that China can be same kind of export base as it was before. China itself is because of the carbon emission norms, reducing many industries. Because of the whole banking system right now, they themselves are tightening many norms. So I don't think, and China, can they bring down their labor cost from $800 to downward? They are only going up. So incrementally, I don't think some of the advantage with China sort of, and China also, by the way, had advantage of everybody well-oiled supply chain. So people were buying because they were buying from there. The inertia to explore any alternative was not there. When we were doing this research in 2020, many companies told us that we didn't realize when China became expensive. Even if we were to manufacture in India, it would have been better. And hence many companies started kind of looking at evaluating. So COVID did one thing, it forced people to evaluate alternative source of supply chain. So क्या होता है कई बार आपके मन में होता है demand is सस्ता, तो you go there, keep buying there till the time you realize that some other store also has come, which could be probably cheaper than demand, right? And then you start evaluating, and you need some catalyst for that. So COVID acted as that catalyst and made world realize that there is something alternative to China, which is possible, cheaper and better. And Indian companies are offering lot of such option to many industries. And currently India lacks is not cost competitiveness, is ecosystem. As the ecosystem builds, more and more companies will start gaining momentum. More and more companies will start outsourcing from India. So today I can tell you many companies are even better than Chinese companies in terms of quality and delivery and cost. But we don't have ecosystem, and that is building. And as that builds, India will give tough on merits the competition to the segment. Vidas, can we take some questions from the hands?
Sure. Ritwij, please go ahead.
Hello. Thanks for the informatory session that you had. My question is basically, so now the clients are even aware about the US debt and all those things. Even in Indian media, a lot of talk about US debt being spiraling out of hands and all those things. And famous investors like Warren Buffett and Michael Burry shorting positions in US. So how do you think, because you are also talking that we should not get the FOMO part of it. And so if somebody investing or entering the markets right now, what will be the best advice? For example, even if I ask them to invest into a mid cap or like a Carnelian structural this kind of portfolio, so what is the time horizon that would you like to advise the customers to look at, considering if something like a US debt bubble or something like that, if some situation happens there? Because definitely, what's your view on that? Because the US balance sheet, all those news are daily, almost like on most of the media channels are flowing in. So what's your take on that, sir?
So first of all, I think it's a good question. I think we don't get carried away by media reports all the time. Of course, is the US debt getting dangerous, out of control? Answer is yes, no doubt on that. US is worrisome. It's painful, but all these things, like I can tell you, I have been hearing about China bubble getting burst for last 10 years. That Chinese banking system is in mess and it will burst anytime, kind of thing. So till the time US is able to, the US dollar is reserve currency. I think they will be able to manage it. Now, whether that status will be challenged, maybe in 10 years, answer is yes, possible. Whether it will change in next 2 years, I don't know. I don't see any alternative. So I think till the time US is a reserve currency, I think they should be able to manage whatever amount of debt they do. And US is a very dynamic market, so I'm sure they will have some challenge, but some way to figure this out. But this is no, not to say that it's not a risk. It is a risk. The important point to understand is whether how integrated India is or how dependent India is on the US in terms of, let's say, today, if you see, our dependence on US flows is very low. When investors sold $40 billion, Indian markets held on. What does that tell you? So, and whatever flows are coming, the FDI flows are very stable and long term in nature, right? So today, in fact, as the growth weakens in everywhere in the world, most global companies and investors are looking to invest into money into India. So I feel if US weakens, India will definitely benefit. Whatever is happening in the rest of the world, it is actually benefiting India. If, let's say, for some reason, Lehman kind of crisis happens, will we not get impacted? Answer is yes. But my own view is that Lehman happened because there was a debt on the private balance sheet. This time around, debt is on the government balance sheet, right? And when it's a government balance sheet, it's a very different ball game than the private balance sheet. So I would say, is it a risk around the corner? I don't think so. Is it a risk some point in time? Answer is yes. I don't know what point in time that risk is, but we cannot not invest into a high, fastest growing economy, fastest growing market, which is relatively insulated to the global economy. I'm not saying not at all integrated. I'll have to take that risk. I can't keep waiting for US to get bust, and the only thing you have to do is that manage your risk and invest into companies which can survive even if there was a 12 months downturn. In 2020 crisis also, people who were invested into good quality companies, realized that in 12 months time everything came back and back to normal, right? So in any crisis, all we have to see is that are we really leveraged? This time around, India corporate is not leveraged, Indian government is not leveraged. We have a very good foreign bank exchange reserve. So if typically risk comes, and in 2008 we got exposed because our current account deficit was high, and our fiscal deficit was high. So whenever you have a twin deficit coupled with the lower leverage, you get exposed. This time around, all are better. FX reserves are good. Current account deficit is in control. Probably looking more going towards current account surplus. Our fiscal deficit is in control. So when you are well balanced, that time, generally speaking, the impact of any global shock should be relatively low.
Sure. Thank you.
So in the interest of time, we'll take the last two questions. Jaidev, you can unmute and you can go ahead. Jaidev? Okay, there's no response from him, so we'll go to the next question from Vinod. Vinod, you can go ahead.
Hi. So my question is, how do you see, though you already see structural growth in banking and financial services, how do you see these large banks faring against PSUs, especially when PSUs are more cleaner, more focused, and delivering incremental growth? How do you see these large players, large banks faring in this?
They will also do well. They will also do well, but we think PSU bank will outperform.
No, but especially they're increasing their market presence also, but their stock prices are just not reflecting, like case of HDFC specifically, or at some point Axis as well.
So I think there are bank-specific challenges which I am not So HDFC Bank is something we have never bought in the last 4 years, and we continue to believe that it will underperform rest of the pack. So there are some challenges out there of integration and so on and so forth. But generally speaking, they will most private sector banks will do 15 to 18% kind of return, and PSU banks will probably outperform.
So you will not be looking at these banks, large banks.
No, we own ICICI Bank. I can tell you that. So that has been one of our large holding for last 4 years, and we continue to hold that because we think that will give 18 to 20% return, which is a very good return because it also brings portfolio stability and balance.
Perfect. Thank you.
The only large bank we own is ICICI Bank. So yeah.
Thank you.
Virat, let's just take quickly all 2-3 questions which have raised hands. So let's quickly.
Sure. Mukesh, you can go ahead. I've unmuted you. There's no response from Mukesh, so we can go on to the next participant is Jayant. Jayant, you can go ahead. I've unmuted you. No response from the participant. We can go to the next question.
Yeah, hi,
Jayant, go ahead.
Yeah, hi. Because I've been invested into the shift strategy, so it's been just a couple of months, and we are still sitting on 30-40% of liquid. So just wanted to check, what would the plan be going forward?
So I think we typically when we get money, we invest into when we buy stock, for each stock we don't have a model portfolio approach because what happens is that in my stock, if something has gone up significantly, for a new investor I buy at higher price, the risk reward for the investor is not in the same favor, right? While my NAV will show good returns, but for the incoming investor it can become bad. So what we do is for every stock we have buy zone, no buy zone, and sell zone. So the moment stock moves out of buy zone, we don't buy that stock. We look for other stocks. So I don't know. I mean, to the best of my knowledge, we should not be sitting on as large as that, but I can still have a look at that. We might have 15-20% cash, but so whenever we find something is just outrageously expensive, or even if we are not selling, at least we stop buying from the new investors portfolio perspective. So and maybe by the time we might have deployed also in last couple of days because you might be seeing the month end portfolios. Yeah.
I'm seeing a regular basis. I'm saying as of yesterday, in fact.
Okay. So it might be possible. It might be possible that we might be sitting. I don't think it'll be 40% for sure, but I can have a look at that.
Okay. Thanks.
We have the next question from Chirag. Chirag, you can go ahead and unmute yourself.
Yeah, thanks for the opportunity. What's your view on EMS and IT sector going forward?
So I think electronic manufacturing is a good play. Only thing is that you have to find right valuation, right company. So far, we find most of the companies are outrageously expensive, and most of the EMS companies have no significant moat, or technology, so to say. So there the valuation. If you buy a company without a significant moat but a good tailwind, then you have to get the valuation right. And so at least we keep looking for ideas, but currently we have no company in our portfolio. IT sector, I have said that we are very, very positive, especially mid-cap IT. We've been looking for ideas which we think can do well. Many companies will transition. In this year, most of our portfolio companies have delivered 50 to 60% return. While they might consolidate here for some time, but still looks very positive. I think take the last question now. Chirag or Mehul? Chirag, can you?
Yeah, he's unmuted.
I think I've taken Mehul's question from chat, but maybe you can take Chirag's.
He's
Hello.
Chirag, can you hear us?
Yeah, I can hear you. So just Vikas, on follow-up to the earlier question, in IT companies, most of the companies posting flat to negative growth and commentary also not good. And even they don't have clarity for the next 2 quarters or so. And even US economy is not showing a sign of relief as such on broader macro parameters. And how Street is giving a very high multiple to mid-cap selected IT companies and even small case in certain cases.
So I think again, look, don't go by the media. Go by what is happening in the sector. If you see in last 2 months, 5 big $1 billion plus contracts have been won by 2-3 companies. Now think about it. How are they winning these contracts if the environment is so bad? See, there are a lot of transformation projects, cost takeout projects which are there, which Indian IT companies are delivering very well, right? So and when a CEO is giving order in this kind of time and environment, obviously he's doing it which is must and very essential. So today you are getting good order book only on essential part. When the interest rates come down and growth environment comes about, you will get development order. So when bad times only you are getting order, when the good times come, you'll get more orders, right? So according to us, many small companies will get larger growth. Larger companies, because of the base, will get a little lesser growth. Hence, smaller companies can grow faster. Like in 2009 to 14 cycle, HCL Tech, Mindtree, L&T, Infotech, LTTS, all those companies got created. In this cycle also, a lot of companies will get created. So our idea is to identify some of those companies from that perspective. So I think we have taken pretty much all the questions. Thank you very, very, very much for joining us on this call. Really appreciate you taking time. I hope we've been able to bring some clarity to your questions, your thoughts. I like every time. I do look forward to have sort of this interaction every quarter. If you have any questions more, please feel free to reach out to any of us. We are always available. Thank you very much. Happy Janmashtami. Enjoy.
Thank you so much, everyone, for joining. In case you have any other further questions, you can drop an email to info@carneliancapital.co.in. Thank you for taking out your time. Have a good day.